What's up, guys? Welcome to the I Will podcast. Today I brought the collective. There's a networking group that I meet with every week to discuss generational wealth and how to keep it. You guys can introduce yourselves.
Sure. My name is Adrian Lores de la Peña, Lotus Law, tax attorney.
Gustavo Rodriguez, Tax Miami, accountant of the group.
Will Paul, I do financial planning.
Pedro Perez, benefit of law. We do estate planning and probate law.
And I'm the mortgage lender of the group, so I focus on helping you achieve home ownership. Now, today we are starting with the first one. We're going to talk about like the worst things happening right now is how bad the rates are. I mean, the debt ceiling, all of that, how that's affecting it. And I wanted to see like different takes as to how this affects each one of your businesses, your clients, and what you think. If you're speaking to one of these individuals in front of you that's asking, what should I do? What's your best recommendation? I want to first start maybe my perspective of it, and then we can go from there. I feel that homeownership is still, even at these high prices, these high interests, is the key to kind of establishing like a base level of your wealth, you know? So I think when I speak to people and I'm like, look, man, I understand it's expensive, but this is kind of like when you used to play a video game or you should kind of save your spot. No matter when you lost, you would start over in that spot. That spot is your home. That's like, if you have that base that keeps you like, okay, that is like my least, like the lowest I'm ever going to go. If you have 5 homes, then, you know, you're building that wealth. But from a tax purposes, you know, like what are you seeing? What do you think?
Well, I completely agree with you. I think that the only tangible thing that you could touch and feel that's never going to go away is real estate. There's so many uncertainties in this world today that having that primary home and multiple homes is the one thing that I see is proven. We niche in our firm more on real estate professionals, so we see who is still making it on these troubled times, and of course that ownership does give you access to deductions to lower your effective tax bracket. So it is crucial in a tax standpoint to own a home, if not multiple homes, to be able to position yourself and avoid taxes in a very safe way.
Yeah. So I have this issue with people that own many properties and they're afraid of losing it, or, you know, when you pass away and what do you do? And this is why, I mean, my next meeting is with you because I need to set up a trust. But what would you say to somebody that wants to start with, hey, look, I'm already starting in my path. I'm already trying to build like my steady little like income from one thing business, income from rental properties. Like how do you think they should structure themselves when it comes to that aspect?
Yeah, so there's multiple ways to own real estate, right? You know, you could own it in your own name, you could own it with partners, you could own it in LLCs, you could own trusts, and sometimes you're using a mix of all of these things, right? And so one of the things that I'm seeing today is, you know, when the economy goes bad, everyone starts suing each other, right? So, you know, people are looking for ways to protect themselves, right? So using LLCs, using trusts, you can protect yourself. But the most important thing is to get the business done, right? So, you know, you're not going to get in a partnership dispute, right? If you don't have a partnership, if you don't have something going on, right? So you got to take that first step, right? The structuring is important, and really, you know, structuring from day one, right? Making sure that you're set up right from day one is the most important thing, right? We see it often where, you know, people get in together and they'll start, you know, investing together, but they don't have anything written down.
Right? They don't have an operating agreement. I see it all the time.
Right? When everyone's getting along, it's great. When business is booming, everyone's great, right? Because, you know, money will sort of smooth over all the issues, right? When money starts getting tight, that's when people start saying, well, hey, hold up, this part is mine, that part's yours, and people start getting a firmer stance. So that's why, you know, from my standpoint, getting things down on paper, you know, for your partners, and more importantly, for your family, right, to protect them, getting that down from day one is most important.
And we're addressing that, right? On every couple of years or every 5-6 years.
Yeah, like renewing it. Absolutely. Like renewing the agreement. From your perspective, I mean, you're who I hired to kind of protect me when shit gets bad with the IRS. Excuse my language.
But IRS is a bad word, man.
Yeah, that's the back.
But the question is from these people, because there's people that are buying houses, renting houses, then selling it, and like me, it happened to me. I had a property, I never wanted to get rid of it, but the offer got so ridiculous. What I got offered, I'm like, the house isn't worth that much. It's just because the Airbnb rental is so good that they're paying me above appraised value for this. And I was like, I got to take it, right? But how can you tell somebody, can we prepare, like, so you don't have to end up like paying back the IRS, something you shouldn't, you know, because I depreciated that year and, you know, they had to dig in for that.
Usually when I meet with a client, the first thing I ask them is, okay, and they mentioned they want to buy a house. My question is, are you buying personal residence or are you doing an investment? And if there's an investment, there's certain different things that go into place that you can take advantage while you own the property. But, you know, it's like the stake on the rose and the thorn, right? You buy the house, but if you sell the house later on down the road and the house is being depreciated, then you might be facing a depreciation recapture, you know. Whereas if you buy your personal residence and you sell it 2.5, you keep it for 3 years, you own, right? You own and lived in the property for the 3 years of the last 5 years. Then if you're single, you can take a deduction, an exemption of $250,000. If you're married, it's $500. So it takes planning with an accountant and myself, and you know, even with a state.
Yeah, I'm working my way up. Actually, no, I started with him.
What about the international landscape? Everybody nowadays has a side hustle, right? It's just now gigs. So the complexities of people coming from different countries in and out of here and having multiple entities or things going on in different places, you know, determining where your tax home is where you have expertise is fundamental in these transactions for real estate.
So like the tax is based on where my primary residence is that what it is?
Yes, and that could change. What if you spend 3 months in Bahamas and then 3 more months in Cancun or Mexico versus other 6 months here? So that creates, you know, you're making money in all these other places. So that presents implications on all fronts. So the complexity nowadays is so much more complex with the globalization of things, and with the internet and AI and ChatGPT. All this stuff is bringing a complexity, and we have so many inherent risks that we don't even foresee that's coming down in front of us.
Is that why so many people are moving to Florida, because the tax or like
yes, exactly,
put as their primary like residence here?
Well, I think Pedro can talk more to it, but there is one thing that Florida offers that I believe no other state in the nation offers it, which is a homestead exemption and the protection that it.
Besides the food and for women.
Yeah. So, but it all comes down. Like obviously, we're talking about homes, real estate, and everything, but these rates also affect like our life insurances and the stock market and everything. And it's important for me to understand because it's something that I'm looking into. I called you about increasing my life policy, and can you explain to me how those rates have affected the what you're quoting people today?
So interest rates have a direct relationship with life insurance dividends. So as interest rates rise, we're coming from a low interest rate environment to a higher environment. So we expect over the next few years for those dividends on the policies to rise as well. As far as with the market, you know, we're seeing with the debt ceiling that you talked about, interest rates, if we zoom out, history will tell us we want mostly equities if we're long-term investing, right? We have a 30-year time horizon. We're going to want mostly equities in our portfolio. But if we zoom in to this year and what's happening, really, we have to think about kind of readjusting our allocation to be more debt focused, at least in this next year, because what we're seeing with the rates, debt ceiling, everything that's going on with the government, this next year, just an outlook, it's going to be very up and down. So obviously I don't have a crystal ball, or I wouldn't be here with you guys. But if we're zooming in, expect a year of uncertainty, up and down.
So, but definitely, that generational wealth that we're going back to, there's, you know, he's the beginning of that path to set yourself up with that policy, so that the day you pass off, you leave along your legacy. That legacy will go transcend to your next of kin and all that, tax free, and also the real estate being set up the right way. When people make such a big mistake, parents trying to be good to their children, they want to put title on their home before they die. It's the worst thing they could do. They're putting themselves in a huge classification.
I love to tell people, you never give anything directly to somebody you love. Yeah. Right. Right. And it's a funny concept, right? But it's for real, right? So, you know, so I have 3 small children, right? Assuming, you know, I get to live to see them to become adults, right? The worst thing I can do is give them something in their names individually, right? Because, you know, both of you can talk about tax implications or the tax advantages of using entities and whatnot, but then also from protecting them, right? Talk about people suing each other, right? You know, that can come in all sorts of ways. It could be car accidents. It could be bad business deals. It could be a divorce, right?
Your wives.
Right. So, you know, there's a bunch of different ways that, you know, what you're leaving onto them can become, you know, somebody else's, right? And by accident, by just bad decisions, things happen. So the worst thing you could do is give it to them directly. And I see parents wanting to do that all the time. And I get it. It comes from a place of love. It's like, all right, well, you know, what do we do as parents, right? It's those of us that are lucky enough to be parents, is, you know,
right?
helping your kids in the best way for them, not necessarily what they want. It's what's best for them, right? And so those are the conversations that I tend to have, and especially today, where a lot of people are scared.
I wanted to touch on two different things. Number one is we'll get into the will versus trust, because I know most Hispanics just, we'll do a will, whatever. They don't know anything about trust. But before I wanted to get into that is, let's say I'm not ready to buy a house today. I'm not ready to buy a house for the next maybe 5 years. I got to save up. Is there something you recommend to somebody that wanted to maybe save up for a house? Like, if my plan is to buy a house in 5 years, like, how can you kind of safeguard my money?
Yeah, it's tough if we're gonna talk stock market, just because, like I said, I don't know what's gonna happen in the next couple of years. So you're gonna want to be in something, you know,
Highly liquid, right?
yeah, highly liquid, risk averse. You know, CDs, money markets, things like that, government bonds, just to protect what you have, your capital. Speaking longer term, that's not the case ever. But as far as protecting your capital early on to buy a property, you're going to want something safe, you know, get your safe, you know, 5, 6, 7%, you know, don't shoot for the stars, because at the end of the day, 3 months before you want to buy your property, all of a sudden you're down 20%. So as far as with clients' money, it's extremely important to know what they're trying to do with it, because every dollar has a job description, right? Let's say someone wants to invest $1 million, right? 300,000 of that might be for the next 3 years to buy a property. So that money is going to be invested extremely differently than if their retirement income or for their kids. So it really starts with goals and then kind of diversifying that money, right? If you have a full million, that every dollar in there is not going to be invested the same.
And I really do believe that getting started for that loan, for that home, starts more on a tax standpoint. Number one, you could park 10 grand into a retirement account, then pull that out for your first purchase and have that penalty free if you do pull it out. But positioning yourself to qualify for that AAA mortgage is ideal, because we know in this market, 1 point of interest means $500 a month. We're talking about 6, 7 grand a year of extra interest. So grooming yourself for that ideal interest rates, which involves a great mortgage broker, a good accountant that understands the mortgage process, and having that team work together to groom you, because that AAA mortgage takes 2 years of good taxes or good financials.
Yeah. So 100%. I mean, I think my perspective as a lender, when I meet with somebody, I become more of a financial like consultant with them, and I go from how to build credit, how to save money on interest, and that's like my two bases. I'm like, okay, look, I could organize your bills and save $500 a month. Now, if I save $500 a month, what are you gonna do with this $500 a month? Can you put it into something else? You know what I'm saying? And how do you do that? But I wanted to go backwards into wills versus trust when you talk about leaving things to your kids and family.
Yeah. So, I mean, a will, basically what it is, just a document where, you know, you're saying, hey, when I die, this is where I want my stuff to go to, right? And be whoever you want. So, some limitations, but basically do whoever you want, right? A trust is the same thing, right? The real difference between the two is that a will has to go to court. It has to go through the probate process, right? The only way that the will actually works is through the court system.
Which is lengthy, right? It takes...
Yes, right? Especially if you have any kind of real assets, right? There's some exceptions where you can do it really fast, but, you know, again, it's for, basically, we have less than $75,000 in assets. You can use a faster proceeding, right? Yeah. Anything above that, right, you know, it's going to be a 7 or 10 month process
with legal fees for the family members, correct?
Right.
Possibly.
Yeah. Right. And actually, at that point, you're required to have an attorney, so there will be thousands of dollars paid out to an attorney, right? Through a trust, right? A trust will accomplish the same thing of distributing your assets to your family, except it does it privately. And the way that it does that is that a trust is kind of like a mix between a will and a company, right? So the trust can actually own assets. You could title things to the trust, technically to the trustee of the trust, right?
It is alive after death.
It can, right? And oftentimes we recommend that it does, depending on the situation, right? And so what happens is, you know, you have investments titled to the name of the trust, right? You have the trustee. You could be the trustee during your life. So basically, you're the president of the trust, right? You're running it, and then upon death or incapacity, that's the sort of added bonus, if you will. You become disabled, you already have the successor trustee. You have that next person in line, right? It could be another family member. It could be a professional trustee, somebody that steps in and now is managing that for your family according to your rules, right? Because in the trust, you're setting your rules as that this is how I want my things to be managed. Now, you want some rules. You also want some flexibility to let life happen.
Exactly.
Right? So that's how, those are the differences. I say everyone that comes to my office definitely gets a will. Everyone needs a will. Everyone needs will too.
Yeah, that was perfect. That was perfect.
But, a high percentage of people get a trust. So the trust is not appropriate for everybody.
Yes.
Yeah. So the reason I ask is because I've experienced this with multiple different friends where there's been multiple wills and for the same person, and they have to go to court to see whose will is valid. I'm not gonna say none of them are fake or nothing, but it's become an issue.
Yeah. I mean, so you can create multiple wills throughout your lifetime, right?
But
Here we have multiple wills. No, but I can create a
But can that happen with a trust?
Yes, a little bit differently, right? So, with the will, I created a will in 2016. I did another one not too long ago, right? And
You get a younger child, so you want to
right, so
You want to update it.
children, right? So, I created a new will, and as long as it's a valid will, it's always the last one that I did is the one
that supersedes.
it's valid, right?
And you got to revoke the prior one by
Right.
destruction or
Right. So the with regards to a trust, right? Again, almost like a company, right? You can change the operating agreements of a company. You could change the rules that you want to operate the company. Same thing with a trust, right? So we can do amendments to the trust, or we can do what's called a restated trust. It's basically just getting the same exact trust entity, if you will, right? And just setting a whole new set of rules.
So it's okay to say that I don't want to give my degenerate son anything. I want to give everything to my cat, and that is fair game in a trust.
I mean, pet trusts actually aren't done.
and I don't know, but there are that one. Yeah. Just to piggyback on real estate and keeping your real estate and making sure that it's transferred the right way. People usually, and I'm sure all of us heard of this, the quitclaim deed.
Yeah, that's
Quickly-
popular.
Well, let me quitclaim deed this property to my LLC, to my trust. Well, you got to be careful, right? If that property has a mortgage, there's an acceleration clause that specifically says if you move this property or if you quote unquote dispose of the property, which is what a quitclaim deed does, you're disposing of the title of the property to another entity. You in a sense, you in essence had activated the acceleration clause. So what I usually do with my client is let's call the bank. Let's run this by the bank. The bank needs to approve it in writing so your acceleration clause is not triggered. Otherwise, you could be if you have a $250,000 loan on the mortgage. Then you might be faced with a $250,000 payment because you just quitclaimed your property to an LLC, even though you're the single owner, right? Which technically you still own the property. But that's something that a lot of people don't realize. Disposing property is not just selling it to somebody else. It's as simple as sending it to an LLC.
Yeah.
And let's not forget all of the other issues that come with it. There's gift tax issues that come into play.
Yeah.
Your property taxes can readjust to
The stamp tax.
right. You got to pay stamp tax. If there's a mortgage, you have to pay
Give that to somebody mortgage, right?
right. You got to pay the doc stamps on as to the amount of the mortgage. So if you have a $200,000 mortgage, state of Florida treats it like if you sold it to your family for $200,000. There's all these things that come into play, right? And one of the things that happens immediately is that the increase in property tax.
Yes,
Right? You
huge.
could lose homestead. There's so many issues.
And hopefully there's an issue now, a big issue now.
So there's something, I did a loan last year, and this lady was primary residence. It was her, she was a single woman, and she had a trust. And she told me, William, I want to close on my trust. And I was like, I don't think we can do that. I don't know. I've been doing this for 20 years, and I still had, this is the first time. I said, okay. I told the bank, I said, let me see the trust. The trust, she's her own trustee, whatever. They approved it. She closed. And from day one, the property with the financing was already set up under the trust. Now, you cannot do that for a primary residence under a corporation. So if that's what you're looking to get some kind of protection on your primary residence and you still want to be able to get your benefits of homestead exemption or whatever, I don't know if that's something that's going to work, but you want to, I guess, consult with the right people.
Yeah. So
Talk about what are the options. I don't know as far as the benefits of me putting my primary under a corporation. Why would you do that? That doesn't make sense to me. I'd do that for investments. But for the purpose of leaving my kids something secured in the instructions exactly how I want to do it, that's why I'll do a trust. I want to mention one thing though. And I actually have a question for all of you. I had a client buy a property straight under a corporation. She built a corporation just for that property. But then she claimed that first year the taxes on her personal 1040 Schedule E. Does that make her liable?
Schedule A, right? On Schedule A,
E.
itemized on E is a rental.
There's rental. She bought that's not property. She bought an investment.
She has a corporation.
The loan under the corporation, she did the corporation just for that property. The property's all under.
If it was under LLC, it'd be a disregarded entity. That'd be okay.
Yes, but it's on the Schedule E for the property. So I'm like, wouldn't you be liable if something happens? Can't they prove that?
Theoretically, yes. You're breaching the corporate veil. It really matters, and this might be more for Mr. Lotus here. It really matters where the income and expenses are going out of. Are they coming out of the corporate account or they coming out of the personal account? For tax purposes, depending on the structure, if it's a flow-through S-corp, same tax implications. So you're pretty safe in a tax standpoint if something ever happens. Now, if it's a C-corp, then it's a different story. But legally, it's more so where their income, right? And
It's a secret.
I have one point to make. Change your account and go see Gus, because whoever did that doesn't know what they're doing.
Definitely horrible idea.
LLCs only for real estate, no corp.
If it's a corporation, it has to be taken on that.
It's a C corp. It's a C corp, and I got a letter from the accountant saying that it's a C corp. She doesn't have to file those taxes. She can file them like this, something, whatever. But it kind of messed up my loan a little bit, which is why I had a little bit of an issue. But I've never seen somebody like, why would you do the whole corp thing? And
Misguided.
you know,
Well,
There is a corporation.
Yeah.
why do we have a corporation in the first place? There's a case that speaks to that. Is Chevron? It's a seminal case in tax law, and it's sort of the same thing. The guy had a property. He was using so Chevron, the big oil company.
Yeah.
I guess they had like the primary residence. They bought the primary residence for the CEO, CFO. I don't recall the facts of the case, but essentially the court said that is a benefit to you, so that's taxable. So even though it was owned by a corporation, and even though it was being paid by the corporation, what the Supreme Court actually went all the way to the Supreme Court. The Supreme Court said something to the extent of, okay, even though it's purchased by the company, even though you're using it, whatever fair market value of the rent that the property could go for, that's taxable to you.
Oh,
That was the house in Key Biscayne. I know that case. That's the house.
that's interesting.
And that's what a lot of people don't know, and they think that taxes, let me just file my taxes. There's a lot more to it than
There's a lot more to it.
In conclusion, making such a big decision or any large decision, you need a team of people because we're not all versed, but you must know a little bit about everything to be able to say, hey, I'm not the mortgage broker. We need.
Yeah, like I'm like, I don't know the answer.
That your job, they want you to be an attorney. You're a therapist for a couple therapist, adult babysitter. So whenever shit goes bad, so we need to be able to say, hey, this is my opinion as your friend, as your client, but we need to bring somebody on board or a team of people.
You gotta know who to ask.
Another thing we're forgetting is the death tax too. So a common strategy we're doing for clients is actually putting a life insurance and the beneficiary being the trust, right? So essentially what that's doing, especially for higher net worth individuals, is when they're getting taxed upon death and they have, a couple kids to distribute that wealth to, since we're talking about keeping generational wealth, utilizing that strategy allows them to essentially avoid fire selling properties, whether they have, a big real estate book or, selling out of their business or whatever have you. So
that tax will pay, the life insurance policy will pay that tax.
Essentially, the beneficiary is the trust. So the trust pays that death tax. So they completely avoid everything because there's honestly horror stories out there of people not doing that. And I'm sure.
Oh, the Dream Hockey Stadium, right? Pro Player, whatever. Now it's called Hard Rock.
Yep.
That was
it's the death tax. So as part of the plan, making sure you're covered in that sense is huge.
And we cannot stress how much we need life insurance. If you have a child or own a home or own a business, or combination of the three, you needed that yesterday. You're never too young or too old. I know Mr. Pedro here changed his profession just because he had a situation, and not knowing the exposure that we have is crazy. So definitely number one, I think before you even think about buying a home or preparing yourself, is structuring yourself for that, because that's that generation wealth. There's ways, not our Latino old school mentality that we think, oh, we'll figure it out. No.
Yeah.
All the Americans have been here for many, many years, do it a whole different way. They're doing it for a reason, guys. So
That's how they've done it. They've utilized permanent
Tax-free.
insurance tax-free to hold that generation.
life insurance is tax-free. Sure, the deductions, the costs are non-deductible, but the proceeds are tax-free. The
Right.
proceeds are way more than the actual fees. So it is crucial.
And I have something to add, and this is just to the general public. I'm sure you guys have gone through this. When you go on Instagram or you go on Facebook and you have a message from one of your friends that's sending you a TikTok and says, "Is this true?" And has that what I call talk expert, right? Where basically they're saying, "Oh, you could do this and that and this," but they're not giving you the whole story.
Yep.
They're giving you only what you want to hear, so they get more views. It's, "Oh, this guy knows what he's saying. Let me go start following him." Right. So be careful with that,
Mhm.
because you gotta have the whole picture before you make a decision.
Trust me, the last 6 months especially, I've gotten TikTok experts walk in telling me how life insurance products works, and I have to kind of
Bring them off of Cloud Nine.
bring them back, take a step back, and kind of explain everything.
Man, switch it. Use it at the strip club.
So, the conclusion, guys. I mean, we started today talking about real estate. We started talking about this aspect of things, and as we go forward, we're gonna break down different segments of, how to take care of your family, economically, what makes sense, what doesn't make sense, and we're here to answer all your questions. If you guys want us to talk about a particular topic, send us a message. But keep in mind, we're gonna do this step by step, and we might be bringing other guests and other people in out just to be able to make sure we address all your concerns. And we want to answer as many questions, but it's hard to get through every little detail, as you mentioned. So any questions you guys have, please hit us up and we'll be able to get back to you as soon as possible. Thank you.